We're working on PA2-1, recording manufacturing and non-manufacturing costs, preparing the cost of goods manufactured report, and income statement. Let's see, Lamanda Corp uses a job order cost system. On April 1st, the accounts had balances as shown in the T accounts below. So we have a number of T accounts. Raw materials inventory, which is an asset account. Work in process inventory, another asset account. Finished goods inventory, asset account. Manufacturing overhead is an income statement account. Cost of goods sold is likewise an income statement account, and of course sales revenue and selling and administrative expenses are both income statement accounts. So you might think about the fact that the asset accounts have a beginning balance, which is typical of balance sheet accounts. Asset, liability, and equity accounts usually have a beginning balance each accounting period, whereas income statement accounts usually start off the accounting period with zero balances since they are closed at the end of the previous accounting period. Okay, so let's see. Following transactions occurred during April. A, purchased materials on account at a cost of $231,970. Requisition materials at a cost of $111,600, of which $14,900 was for general factory use. And C, recorded factory labor of $223,800, of which $43,775 was indirect. And D, incurred other costs, and those costs are listed in this short schedule: selling expenses, factory utilities, administrative expenses, factory rent, and factory depreciation. So these are all expense accounts. And so in accounting for job costing, one requirement is to separate costs into period costs and product costs. Product costs are those costs which become a part of the final product, as opposed to period costs or period expenses, which are expenses that are charged to the current accounting period. And let's see, we have another 4 transactions that we have to deal with. E, applied overhead at a rate equal to 143% of direct labor costs. F, completed jobs costing $262,150. G, sold jobs costing $323,370. And H, recorded sales revenue of $518,000. So let's see what the requirements of the problem are. Looks like we have a number of requirements here. And requirements 1 and 2 are asking us to post the April transactions to the T accounts and compute the balance in each of the accounts at the end of the month, at the end of April. So let's go back to transaction A. Purchased materials on account at a cost of $231,770. So we're going to add materials purchased to the raw materials inventory account. That's $231,970. And the purchase was on account, and so Normally we would be crediting accounts payable for that transaction, but we don't have a T account for accounts payable, so the only thing required for transaction A is going to be the debit side of the transaction, again adding it to raw materials inventory. Transaction B, requisition materials at a cost of $111,600. So in job costing, when we requisition materials, we essentially take those materials out of inventory. So we are requisitioning materials at a cost of $111,600. So we credit inventory for $111,600. And our debit is going to be to two accounts, since part of that material requisition was for direct materials and part of it was for indirect materials, those materials identified as for general factory use. So we're going to have to subtract that $14,900 from the $111,600. And got an adding machine here. So $96,700 will be debited to work in process as direct materials, and $14,900 will be debited to manufacturing overhead as indirect materials. Now I might remind you at this point that we have this check my work feature that is available for all of your homework, and so it might be a good idea from time to time to check to see that what you've done at any point in time is correct or not. And so I simply clicked on the check my work link, and I can see that we are okay so far. Now we go back to transaction C, recorded factory labor of $223,800, of which $43,775 is indirect. So when we account for job costs for our jobs, the three main components of cost for manufacturing when we are using job costing are direct materials, direct labor, and factory overhead. Factory overhead includes indirect materials, which was the $14,900 in our example here, and it also includes indirect labor, which is this $43,775 as part of transaction C, and then it also includes other factory costs, which we're going to deal with in transaction D. So let's record transaction C. So we have factory labor, which includes direct and indirect labor, of $223,800. And of that $223,800, $43,775 is indirect, which leaves us with $180,025 as direct labor. And so direct labor is debited directly to work in process inventory. And again, that's $180,025. And the balance, which was our indirect labor, is debited to manufacturing overhead. And again, that amount is 43,775. And our credit would be our various payroll liability accounts, which we're not dealing with in this problem, just as we didn't deal with the accounts payable account credit in the first transaction. But just know that there would be a number of credits that would be recorded as a part of this payroll entry to record labor. Okay, transaction D. Now there are some other costs, and they're listed in this short schedule here as selling expense, factory utilities, administrative expense, factory rent, factory depreciation. So again, if we're manufacturing and we're using job cost accounting, then when we record our expenses, we need to separate those into product costs, those that become a part of the finished product and are accounted for as such, and period costs or period expenses, those that would flow through the income statement in the current accounting period. And so our selling and administrative expenses are those period expenses, and our factory related expenses, which include factory utilities, factory rent, and factory depreciation, are accounted for as manufacturing overhead. Just as indirect materials in transaction B and indirect labor in transaction C, just as they were also accounted for as manufacturing overhead. So we're going to record these as a debit in total for those three factory costs, the 23.3, the 11.1, and the 19.6, 54,000. So our 54,000 would be recorded in manufacturing overhead, and the balance of those expenses, which are the selling expense and the administrative expenses, we're just going to throw into this T account, which is called selling and administrative expenses. And so that's going to be transaction D, and the total there would be 34.5. And 51,450, 85,950. And again, our credits would be to various accounts. Could be accounts payable, maybe cash for some, and maybe some other liability accounts for the credits to record that transaction. Okay, and again, let's do a quick check my work just to see that we're okay. And looks like we got one amount that is incorrect, and that's our debit in that's interesting. The debit into manufacturing overhead, as well as the debit to selling and administrative expenses, both show as incorrect. We need to check those out. Let's see. So we have factory utilities of 23.3, factory rent of 11.1, and factory depreciation of 19.6, and that's 54,000. Let's see, it could be that they want to see those amounts separately, because I see that we have 3 slots here on the debit side, and I'm showing the 3 together as one total. So let's see if we separate those. 23.3 and 11.1 and 19.6. And my guess is that they're also looking for 2 separate amounts in the on the debit side of selling and administrative expenses. I put both of those amounts together into one total, and they probably want 2 separate amounts. Selling expenses of 34.5 and administrative expenses of 51,450. And let's do a quick check my work and see if let's see, we need to do that one more time. Yep. So they wanted each of those 5 amounts recorded individually in the T accounts. So we're okay. Okay. Let's see. So we're on transaction E. Applied overhead at a rate equal to 143% of direct labor. Now, when we account for our job using job costing, we need to basically move our move our overhead, which at this point in time is 112,675. Move that cost into our work in process inventory, which is the inventory account in which we account for our products that we're manufacturing. And so we do that using what is called a predetermined overhead rate. And that predetermined overhead rate is calculated at the beginning of each accounting period, and it's based on the ratio of direct labor and overhead. So in this problem, it's telling us that applied overhead overhead is applied at a rate equal to 143% of direct labor costs. So we would take our direct labor costs, which if we go back to transaction B, we see was 96.7, and we multiply that amount by 143%, or 1.43, and the resulting amount is 138,281. So we are going to apply overhead And when we apply overhead, what we're doing is we're crediting the overhead account, 138,281. Let's see. I need decimals there. 138,281. we are crediting the overhead account, and we are essentially moving this cost into work in process or into production. So we debit the work in process account for 138,281. At that point in time, the total balance in our work in process account is $434,806, and it's comprised of $19,800 of costs that were carried forward from the previous accounting period. That's our beginning balance. It also includes $96,700 of direct materials, and in C it included $180,025 of direct labor. And I'm thinking, I wonder if I used I used the wrong amount here when I calculated the overhead applied. I used the direct material amount, and I should have used the direct labor amount. So this 138,281 is not correct. I need to recalculate that overhead applied amount. And again, overhead applied at a rate of 143% of direct labor. And so our direct labor is 180,025. And we use a rate of 1.43 or 143%. So that is 257,435.75. It looks like a really big amount. And right now our manufacturing overhead is over applied by a pretty big amount as well. This 144,760.75. And so what we probably should do is check that entry and make sure that we're okay. And let's hope we are. And we are. So our applied overhead is this very large amount, 257,435.75, which is taken out of the overhead account, leaving a credit balance in manufacturing overhead. That's referred to as over applied overhead. We have actually applied overhead at an amount more than actual overhead incurred in that account and recorded in that account. So we've taken that overhead and moved it into work in process. So our total work in process inventory balance at this point is 553,960.75. Okay, let's see, where are we? Okay, now we completed jobs costing 262.5. So our job mix is accounted for, our job costing mix, direct materials, direct labor, and overhead is accounted for in our work in process inventory account. So when we complete a job or jobs, we take the total of those jobs completed and we move it out of the work in process inventory account. So in this case, that total is 262,150. And so we take it out of an inventory account with a credit. And since it's no longer in process but finished, we move it into the finished goods inventory account with a debit. And the next transaction is to record the sale of jobs. So we had a beginning balance in our finished goods inventory from the previous accounting period, and so transaction G is telling us that jobs with a total cost of $323,370 were sold, and so we need to move that amount of cost out of finished goods inventory, and that's our transaction G. We credit finished goods inventory for $323,370, and of course our debit would be to cost of goods sold. So what we have done here is recorded the cost of those jobs sold. So the last transaction would be to record the revenue for those costs sold, and the amount of that revenue is given in transaction 8 as $518,000, and that is recorded as a credit, 518. And our debit would be to probably accounts receivable, or maybe to cash, or a combination of the two. So again, we want to check our work, and let's see if we're okay. And it looks like we are okay up to that point in time. And so we have recorded, we have completed requirements 1 and 2, and which basically requires us to record those 8 transactions into the various T accounts. Let's see. Requirements 3 and 4, compute over or under applied manufacturing overhead. Well, the way we do that in a problem like this is relatively easy. We simply go to the overhead account, check the balance. If the balance is a debit, that means our overhead has been under applied. We have applied overhead or moved it out of overhead into work in process at an amount less than actual incurred overhead. Or, as in the case of our example, if it's a credit balance, that means that we have actually over applied overhead. We have moved more overhead into our work in process account than we have actually incurred and recorded in that account. So at that point in time, our overhead account balance is a credit of $144,760.75, which represents over applied overhead. That is requirement 3A. Requirement 3B, if the balance in the manufacturing overhead account is closed directly to cost of goods sold, what will cost of goods sold, will cost of goods sold increase or decrease? Well, to close a manufacturing overhead account, which is an income statement account, if it carries a credit balance before closing, we would have to debit it to close it, and our credit would be to cost of goods sold. And since cost of goods sold is an income statement account and it is a cost or expense account, then if by crediting a cost or expense account, that account balance would decrease. Since a cost or expense account, the normal balance is a debit. So by crediting that account, we're going to decrease that account balance. Transaction 4 and 5 require us to complete a couple of statements, and In job costing, one basic statement that is new to manufacturing and job costing is a statement of cost of goods manufactured. In a merchandising operation, we generally buy the merchandise, which is represents our product that we sell, as opposed to a manufacturing type of operation or business in which we make our product that we sell. And so when we're manufacturing or making our product that we sell, we account for it in the form of a separate statement. Of course, we account for it transaction-wise and using the T accounts, the ledger accounts, as we do all of our transactions. And then for reporting purposes, we also use a separate additional statement that only manufacturing entities use, and we call that the statement of cost of goods manufactured, or the cost of goods manufactured report. And again, thinking in terms of what's included in our manufacturing costs when we are making our product, basically direct materials, direct labor, and manufacturing overhead. And so the reporting is a little different. It's a little tricky. When we take a look at our materials account, we see that our beginning balance is $29,700. We purchased materials of $231,970, and we applied materials of $111,600, which included direct materials of $96,700 and indirect materials of $14,900. And so when we do our statement, we're going to start with our beginning raw materials inventory amount, which was $29,700. And we're going to add the amount of raw materials purchased, which was $231,970. And we're going to take out of that total our indirect materials, which we accounted for as manufacturing overhead. That was $14,900. So we need to show that as a minus $14,900. And then we subtract our ending raw materials inventory balance, which is $150,070. And the resulting amount should be the amount of direct materials used, which if we go back to the work in process inventory account and also back to the transaction itself, well, the transaction doesn't give us the amount, but the amount is the result of taking the raw materials the raw materials requisitioned and subtracting out the indirect materials or manufacturing overhead portion. But our T account shows that amount, which is $96,700. And so we need to do this calculation on our calculator. $29,700 plus $231,970 minus $14,900 and minus $150,070. and our resulting balance is 96.7, which is the amount of our direct materials used. Okay, so we have our direct materials calculated through this formula, which shows up on our cost of goods manufactured report. Now, for direct labor, it's much more straightforward. We simply go back to the transaction, and it tells us that total labor for the period was 223.8, indirect was 43.775, and so the direct labor, which is the amount that is accounted for in our product as direct labor, would be the difference between these two amounts, and we have already subtracted those two and recorded it in our work in process inventory account as 180.025. And then finally, we add our manufacturing overhead applied, and for that we can go back to the transaction, which was transaction E, and that told us what our application rate was, which was 143% applied to direct labor. And when we did that calculation, our amount was 257,435.75, and so that's the amount of direct manufacturing overhead applied on our statement. Again, let's go back up there, 257,435.75. And if we add those three amounts up, direct materials used, direct labor, and manufacturing overhead applied, that gives us our I'm looking for a heading that isn't here, a description that isn't here. And so I'm thinking that that should be our amount. I think that's calculated automatically. Our total manufacturing cost, which is comprised of our direct materials used, 96.7, and our direct labor, 180.025, and our manufacturing overhead applied, 257,435.75, 534,160.75. So that's that total. And then we also have to account for the beginning and ending inventory balances in our work in process inventory account. So as we do with other inventory accounts, we add the beginning and subtract the ending. The beginning balance represents cost that is part of our current costs, and our ending balance represents costs that are not are accounted for in finished product that will show in the following accounting period, next accounting period. So we add beginning balance and we subtract ending balance. And so let's do that. We add beginning balance of work in process, which is 19.8, and we subtract ending balance of work in process, which is $291,810.75. And that gives us our cost of goods manufactured. If we add down from total current manufacturing costs, plus 19,800 minus 291,810.75, 262,150. And are we okay here? We might have done something wrong here. This amount, cost of goods manufactured, should be the amount of our cost of goods sold. And I'm thinking that because we had over applied inventory, it's going to work out for us. So let's, well, I guess the first thing to do would be to check my work. And let's see how that looks. Okay, so we're okay. According to the check my work, cost of goods manufactured is 262,150. And again, what I'm saying is that this 262,150 should basically be our cost of goods sold, since oh no, I take it back. What we manufactured is simply the amount that we move from our work in process into finished goods. But cost of goods sold represents the cost of jobs sold, not necessarily finished. So we're okay. So we had 124,400 in the finished goods inventory. We added 262,150 for jobs finished, and then we sold 323,370. So we still have job costs in finished goods inventory of 63,180, and those jobs will probably be sold next accounting period. So we're okay here. Okay, and then finally our income statement. We usually start off our income statement with sales revenue. And our sales revenue was 518,000. Our cost of goods sold, let's see how that is being accounted for. We need to add in our finished goods inventory, and we need to subtract out our ending finished goods inventory, and we need to show our cost of goods manufactured in the middle. So our beginning finished goods inventory is 124,400. Our cost of goods manufactured is off the statement 262,150. And then our ending inventory, finished goods inventory, is off the T account 63,180. And that's subtracted. I show that as plus here. It should be subtracted. Ending, less ending finished goods inventory, minus 63,180. And so our unadjusted cost of goods sold would be the total of these three amounts, 124,4 plus 262,150 minus 63,180. 323,370. And then we need to adjust for our over applied overhead. So again, if our overhead account shows a credit balance, then when we close it, we would debit that amount and credit our cost of goods sold. So that's going to be a subtraction from cost of goods sold for over applied overhead, which was 144,760.75. And our adjusted cost of goods sold would be 323,370 minus our adjustment for over applied overhead 144,760.75. Or 178,609.25. I think at that point we should do a check my work again, just to be sure we're okay. And I always cross my fingers here, and we're okay. And finally, our last two items on the income statement would be our two period costs, our selling expenses, 34,500, and our administrative expenses, 51,450. I'm sorry, I forgot that we need to show that revenues less cost of goods sold is gross profit, and it's a positive amount. $339,000, $390,075. And then we subtract our selling and administrative expenses. And here on the statement, we can put two of those together. 85,950. To give us our net income from operations. $253,440.75. And again, we're done here, but we need to make sure that we're okay. Check my work. And fingers crossed, and we're okay. Okay. That took us not quite an hour. I show 50 minutes on my recorder here. So it'll probably take you on average, oh, I don't know, anywhere from an hour to maybe up to 2 hours on the high side, I would think. Not all of this is as easy for you as it is for me. But I think if you get into the chapter reading and follow the examples, I think you should be able to work through a problem like this with a fairly good understanding of what's happening. Okay, so the last thing we need to do here is we can either save and exit, which allows us to save the problem and come back to it at a later time, or we can simply submit. And so I'm going to submit, and let's see. Oh, looks like I forgot part of the problem. Question 101, click below to return to the incomplete question. And where is that incomplete question? Where's the question? Question 101 here. I'm not quite following what that's telling me. I'm going back to the check my work and see if I can figure out why it's showing as incomplete. Answer is not complete. It could be that adjustment to manufacturing overhead and cost of goods sold. So let's try that. It doesn't specifically say in the transactions to adjust over or under applied overhead, but let's see if it lets us do that. So I'm not sure. Probably a part of transaction E, I would think. No? Job sold. Transaction G, maybe? No? $178,609.25. That should be the amount of our cost of goods sold. So that's the same amount here on the income statement, $178,609.25. And we don't have a space here to show the credit, the debit rather. Let's see what happens when we check. our work here. Still shows as not complete. So I guess it doesn't want that entry. Well, I'm gonna submit it, and then I'll have to go figure that out. And so I want to take this out, take this out. I'm going to save and exit. Yeah, that might be a better option. And then I'll go check this out and come back to. Okay, so I'm back. I checked it out, and I can't see why this problem is showing as incomplete. As far as I know, it's complete, and I'm going to submit it. It's probably going to dock me a point or two or whatever, but it's pretty complete as far as I can tell. So I'm going to press submit. And it's showing something incomplete, and I'm going to say submit anyway. And I got 14.78 out of 15. So let's see if this is going to show me. Oh, I'll be darned. Well, I see what was incomplete. When I recorded the credit to sales revenue, I failed to show the transaction letter. Okay, well, that's an error. So I didn't get a perfect score on this one. But the rest of it is okay. So I would I would probably take it if I was doing it. I would probably just take it as is. Okay, so great. I'm gonna shut this off and post it, and hopefully it'll be helpful to you. Thanks. Aloha.